live, Grace?
We're live.
Are we live? What's going on, everybody? Good afternoon, good evening, good morning, wherever you are at. Happy to have you guys on with me today. We've got a very, very special guest at a very, very special time for some very, very special education. And it's actually one of my favorite topics that I like to talk about. If you guys have been tuning into our program, I've had several different workshops where I've either mentioned or dove into very low level, talking about unrelated debt finance income tax and unrelated business income tax. What the heck does that mean? And what does it have to do with IRAs? Well, we're going to talk about that. And I can tell that you guys want to hear about it because our registrations jumped through the roof on this. So I'm really excited to have all you guys. And again, my name is Nate Hare. I am the Director of Retail Sales for NuView Trust Company. I oversee the IRA Specialists Department, who are the people that talk about IRAs and how self-direction can be advantageous to you if you are looking to take your money out of the stock market and get it invested into more tangible assets like real estate, precious metals, cryptocurrency, yada, yada, yada. But one of the most talked about topics that I think people get a little bit confused on or have some misconceptions on is this topic about buying real estate in an IRA with the acquisition of debt or buying into businesses with your IRA, owning businesses. Is it prohibited? Is it taxable? Can I do it? We're going to talk about that. And we have a CPA who's very knowledgeable about it, and you can't find too many CPAs that understand the concept of unrelated debt finance income tax or specialize in it, and UBIT. And we have Adam Barr on with us today. So we're going to bring him on in just a second. But let's get into it. For anybody who is new to the program, NuView Trust Company is a licensed and bonded trust company. We manage our administrative services out of Florida, even though our trust company is in South Dakota, but we have clients all over the country that use their self-directed retirement vehicles, whether that's IRAs, 401ks, HSAs. I'll talk about the types of accounts that we have here, but they use those types of accounts to buy alternative assets instead of traditional assets. Don't get confused by that term, self-direction. It's just a marketing term. It doesn't mean anything. Our industry uses it because a company like NuView Trust Company doesn't have investments to sell. We're still a custodian of retirement accounts, like a Fidelity or a Charles Schwab is a custodian of retirement accounts, but they're licensed securities brokers that sell you investments. We're a trust company that doesn't sell investments. The advantage to being set up like that, from our perspective, is that we don't have to be licensed to sell you anything. Therefore, we can hold anything the IRS allows in our clients' accounts. But here's where the self-directed part comes. You self-direct the IRA. You tell us what you want your IRA invested in, and then we'll sign off on the purchase agreement, sign off on the contract to show it's owned in the IRA, and therefore you get your tax advantages. So that's kind of how it works on a real brief explanation, but don't get confused when we're talking about self-directed IRAs or self-directed retirement accounts. We're just talking about IRAs and retirement accounts that you have to choose your own investments. What are the advantages of having a self-directed IRA? If this is their first time tuning in, we talk a lot about the advantages to having a self-directed IRA. There's some disadvantages too. There's no magic washing machine for people to use as far as IRAs go that just solve all your investment problems. But what the self-directed IRA provides as a solution is the solution to invest in things that A, you're knowledgeable about. So if you're a real estate investor and you would rather own rental property or land in your retirement account than Walmart stock, you can do that. You probably don't know you can do that because you have to work with a company like NuView Trust Company who can hold those types of alternative assets like rental property or land in your retirement account. You never hear about it from Fidelity or Charles Schwab because they don't sell that as an investment. So most people, because they have their money parked at the big guys, they never hear about those as options as a retirement asset. So one of the things it gives you is not only the ability to invest in what you know best, but a self-directed IRA allows you for true diversification. And this is not diversification into high-risk mutual funds, medium-risk mutual funds, and some low-risk mutual funds. I'm talking about diversification where maybe some of your retirement portfolio is invested in mutual funds, stocks, ETFs, or those paper assets, those traditional assets. But then you have some of your retirement portfolio invested in real assets, rental property, precious metals, even cryptocurrency. You make an argument for that that's a more tangible investment. It has its ups and downs, but again, if you're knowledgeable about cryptocurrency, why not invest crypto in your IRA cryptocurrency instead of things that you're not knowledgeable about? So that's where the power in the self-directed IRA comes in, is that you can invest in what you know best. But it doesn't fit everybody's needs, because if you don't know what to invest in, then you shouldn't have a self-directed account. It's just going to sit like a rock and do nothing. So most of our clients have self-directed accounts with NuView, but they still keep a brokerage account with Fidelity, and they just move money back and forth depending on what they're investing in. The biggest thing IRAs give us, though, and we're going to talk a little about some nuances to this, but is the tax savings that IRAs give us. IRAs, by definition, are tax-exempt trusts. You're just the fiduciary of the trust if it's your IRA. Your job as the fiduciary is to make it grow, and provided you play by the rules, meaning you invest that for your retirement and you try not to take distributions until you're above the age of 59 and a half, the trade-off is you'll never be taxed on those gains as you buy and sell investments, whether it's rental property or stock, as you're buying it in your IRAs. There is a nuance, though, and this is one of the things that we're going to talk about today, where there are certain investments, if you invest in certain things, that make your IRA become a taxpayer. We're going to dive into that in a little bit, but I don't want that to scare you. What I tell clients about this little tax that we're going to talk about is there's some advantages if you're investing in something to offset the tax. So when you're looking at an analysis as to whether to invest your IRA in something that's completely tax-free, or investing in an investment that you still get some tax benefits, but you might have to share a little bit of the profit with Uncle Sam, there's an analysis there. You don't want to just get scared away because your investment might be taxed. You want to look at your cash on cash returns and other things. So we're going to talk a little bit about that. And again, I'll save some of that for when Adam's on here so we can talk about it a little bit more in depth. But IRAs in general just give us greater tax savings than us as tax-paying individuals. So if you're not using an IRA to some degree to buy and sell some of your investments, I would say you're just going to give Uncle Sam too much of your money investing with your own dollars in your own pocket. These are the types of IRAs, self-directed IRAs, that we have here at NuView Trust Company. Now, some of these aren't IRAs, but I'm just trying to make this easy for you guys. The IRAs that we have would be your personal plans there, which are Roth IRAs and traditional IRAs. If you want to know more about how they work in comparison to each other, just go to our YouTube channel. I've got presentations on how those work, and we go into depth on that. But you can use either one to self-direct and buy any types of alternative assets that you can find. When you're talking about investment options in these accounts, the IRS only limits us to 2 investments. There's 2 investments you can't own in an IRA: life insurance contracts and collectibles. That's it. Anything else is fair game. So as long as you have a custodian that will sign off on the investments, you can invest in almost anything with these accounts that you're looking at here. So I mentioned the personal plans, traditional and Roth IRAs. These work well for anybody that's got earned income and anybody that wants to grow an account with some alternative assets within them. If you're looking to make larger contributions and you have the opportunity to show some self-employment income, we also have employer plans for people who own small businesses, people who are CPAs, attorneys, maybe real estate agents. They like to use their employer plans to self-direct, like your SEP IRAs, your simple IRAs, or we even have a very powerful product called the Solo 401k. And that's something we'll talk about on this program as well. And we even have non-IRAs, non-retirement plans that also work in a tax advantage sense. And you can also invest these into alternative assets, but the tax advantages on the growth can be realized immediately by using what's called a health savings account. And we even have an education savings account. These accounts are not made for retirement, but you can use these vehicles to invest and take the profits out tax-free and penalty-free to pay for today's expenses. Healthcare for you and your family, education expenses for your kids. And again, this isn't the topic today, but if you want to learn more about those types of accounts, just go to our YouTube channel or our website. You'll find a ton of information there that dive into those accounts specifically. The main thing I want you guys to get from this slide, though, is all of those accounts can be used individually. They can also be used together through partnerships. And I'm not talking about a partnership agreement. I'm just talking about different buckets going in involved in the same investment. So oftentimes when I do an investment, I like to include my Roth IRA, maybe even my Roth 401k, my health savings account, and education savings accounts for my nieces. And all of those tax advantage accounts work in simultaneous on whatever I'm investing in. And all the profit that's coming back to those accounts, whatever I'm investing in, is all tax-free. So if you want more information on that, just contact us and we'll have some more information at the end here. What do our clients invest in? Here's some of the most common investments we see at NuView Trust Company. We have about 15,000 clients. We have about $2 billion in assets. They're all invested into mostly the things that you see here on this page. A lot of clients like to invest in real estate. Whether it's active or passive, you can do that. Be careful with the active piece, but a lot of people who like finding active real estate investments, they're finding rental property, land, commercial property, apartment buildings. All of those can be owned in an IRA. Just work through a company like NuView so we can show you how that's done. We also have a lot of clients that choose to be more passive with their retirement account. They don't want to deal with toilets and tenants, but they like the income to come in either through interest payments from somebody else that's doing the work, and that would be done through a promissory note. That's a common investment in a self-directed IRA. We also have clients that like to be passive into other people's deals like syndications, people that are raising money to buy apartment buildings or, again, commercial property, skyscrapers. You'd be shocked how much money, how much capital is actually sourced from retirement accounts. When you drive around and look at all those buildings in your community, a lot of retirement accounts are used to own that, and you can be a passive investor with your retirement account into private investments like that, not just publicly traded investments. And we have a lot of clients that are also investing in cryptocurrency. That's also considered an alternative asset if you want to own the coins directly and not just some ETF or some mutual fund that's investing in that. So these are some of the common investments we see at NuView, but again, anything you can own, hold title to, anything you can own outside of life insurance contracts and collectibles is allowed in a retirement account. So if your broker's saying, no, you can't do it, that means that no, you can't do it with them. Just call NuView and most likely we understand how to process that investment in your IRA. So as I transition here, we talk a lot about real estate. Real estate is a phenomenal investment, and I'm not pitching real estate, but if you think about the fundamental difference between a piece of real estate and, let's say, a stock. Well, real estate's tangible. It's got multiple income streams. The industry is not going anywhere. But how do you buy property? How do you leverage yourself if you've only got a small IRA? We've done a lot of courses in the past where we talk about using leverage. And this is, again, one of the fascinating things with self-directed IRAs is the ability to use leverage. Leverage from bank financing. There's banks that have IRA loans. If you wanted to use your IRA for a down payment and leverage the rest of the capital from a bank, you can do that. But there's a tax that kicks in. We're going to talk about this. There's also the same tax, not taxed the same way, but it's the same topic when your IRA invests into other things like businesses. And I'll let Adam Barr, who's the specialist on this, dive into this. But there are certain investments that become taxable, not to you, the person, but to the IRA. And again, when we talk about this, it's something to be aware of, not something to be scared of. So let's go into this real quick. And I want to bring on Adam Barr. Adam, are you with me there? Go ahead and jump on.
Sure. Hello.
Hello, sir. Adam, I've known you for a long time, but we just kind of first met. And the reason I want to say why I know you, because, well, I'm kind of an IRA nerd. And I know that there's not a lot of CPAs out there that specialize in unrelated business income tax. And when I hear of one, I never forget them. And I saw you on a presentation that you were doing a while back, and I just thought to myself, I got to get him on with me at some point when we get to this topic. So I appreciate you coming on and joining us today, especially during the season that you're in right now, because I'm sure you're a busy guy. So thank you for taking the time. And just to give a little introduction, I'll let you talk about yourself here in a sec and tell the audience who you are. But Adam's a CPA, a partner at MGA Capital out of Houston, or MGA out of Houston. They work with a lot of small and mid-sized business owners, but they're very, very knowledgeable when it comes to the space of unrelated business income tax and unrelated debt finance income tax. And I'm sure that you get a lot of people with IRA investments that come to you, and they're also small business owners. So I know you're a busy guy, but you got a lot of knowledge, and I couldn't resist trying to get you on the program. So again, thank you for joining us. Tell the audience about yourself.
Yes, sir. And then thanks for the invite. I'm happy to be here, and it's good to spend some time with you in the audience and answer some fun questions. So that'll be great. As you mentioned, I work at MGA LLP. I say I work here. I'm one of the partners. I guess I really shouldn't say I work here anymore. But I'm a CPA here in Houston. I've been working in the Houston public accounting world for almost 10 years. As you said, I have significant experience with UBTI and UDFI. Just accidentally became an expert on that several years ago, and it's kind of stuck with me. And I also do a lot of work with real estate investors and like multifamily real estate, like apartment buildings, and also commercial real estate, strip malls, office buildings. All tax issues related to those sorts of things are things that I handle on a daily basis. And then in addition to that, I work a lot with small and medium-sized business owners here in Houston and around the country and around the world to assist them with tax planning and compliance. So those are sort of the things I do the most, and I'm having a great time, and I'm happy to be here and ready to talk about UBTI.
Awesome. And I'll remind everybody who's watching, if you have questions along the way, we're going to have this as an open discussion. Adam's not doing a PowerPoint. We're just going to have an open discussion and have some talking points here. So if you have specific questions, type them into the chat box. I know how you guys work out there. Sometimes it gets real specific. So I might have to defer some of those to maybe a one-on-one conversation that you have with Adam or his group, but we'll try to get to all the talking points here and any of your questions. So just type them into the chat box. So I guess we'll just start with this, Adam, is let's just define it. Let's just tell people, what is UBTI, what is UDFI, and how does it relate to an IRA? And I'll let you take it away and talk about it, because I've talked about it so much, but you're going to give a way better definition than I would.
I'm happy to do it. So I think we really have three acronyms here that we need to be aware of, and that's UBTI, which is Unrelated Business Taxable Income, and UBIT, which is Unrelated Business Income Tax. And then the third one you just mentioned, UDFI, which is Unrelated Debt Financed Income. So we're going to just sort of go over those real quick. So UBTI, Unrelated Business Taxable Income, is the actual income that you're receiving. It's just like you think of on your own personal tax return, you have taxable income from your job or your interest expense, or interest income, things like that. That's the income. UBIT, or UBIT as it's sometimes referred to, is the actual tax that's due on that income. So I'm just drawing a clarification between those two terms. And then UDFI is a type of UBTI. It's a type of income that is subject to tax in the IRA. So that's sort of the definition of those three terms. As for what UBTI really is, in a general sense, it's income that's generated by a tax-exempt entity by means of taxable activities. And what that means basically is that you have a tax-exempt entity, such as an IRA, that's carrying on a business of some sort, or it has debt leverage on an investment. So we'll get more into that in a minute. And it's not just IRAs, by the way, it's any tax-exempt entity. So if a nonprofit organization has a business, it also applies to that nonprofit. The purpose of this tax, as I've seen it explained, at least legally, is to eliminate unfair competition by making sure that tax-exempt entities that are conducting a business have to pay tax as well, so that they're on an even playing field with ordinary businesses that don't have a tax-exempt status. So it's sort of that's the idea, is a leveling of the playing field among everybody who's doing business. So let's talk a little bit about what situations would cause a self-directed IRA to have UBTI and therefore possibly owe unrelated business income tax. So there are really exactly two situations that would cause an IRA to have UBTI. The first one would be that the IRA is conducting a business activity. So a common example that we see all the time is people are flipping homes or buying a tract of land and developing the land and then selling the lots to a building developer, things of that nature. But really, it can be almost anything that's a business. I've seen an IRA that owns a retail store. I've seen an IRA that owns a laundromat. Really, the list of things is pretty much endless. But if you're doing something that's really a business activity in that IRA, then that income is going to be unrelated business taxable income, or UBTI, and you're going to pay tax on it. And in fact, in that case, all of it would be UBTI. The other situation where the IRA would have UBTI and therefore would maybe pay some tax is if the IRA has income from a debt leveraged asset. This is what we call unrelated debt financed income, or UDFI. So basically, anytime you have an asset within an IRA that was purchased with debt, the income from that asset is going to be taxed within the IRA. The IRA is going to have to write a check to the IRS and say, here you go, here's my taxes on the income I earned this year. The most common examples I see are rental real estate, where either you're buying like a single family rental property or a duplex with your IRA and you're taking out a mortgage to buy that property. And then the other really common scenario is you have pass-through income from a partnership or LLC investment. So for example, you invest in an LLC that is purchasing an apartment building, and when the LLC purchases that apartment building, they use debt for that purchase. That income would then be unrelated debt financed income, and it would be subject to tax. But it's only to the extent that the income is debt leveraged, which I think we'll discuss a little more later on. But
Yeah,
that's kind of an overview.
Yeah, and I was going to make that point. There's a distinct difference between, I guess, UDFI and UBIT. Even though UDFI is a piece of UBIT, UDFI is speaking specifically to just the debt leveraged piece. And that's where I think that some people get confused. Whereas if you're investing into a business, like you mentioned, it would be unfair if IRAs could go out there and buy pizza shops. They'd sell pizza cheaper than the other people that have to pay taxes because they own it personally. So I like how you said that. It's just a leveling of the playing field. If you're going to go out and buy and own a business in your IRA, it doesn't mean it's a bad investment, but they're going to level the playing field on you and make the IRA pay some sort of tax if it's owning and running a business. But then there's the other side of it, which I think is very common, at least in our industry, because we have a lot of clients that either go out and buy their own rental property and they use some debt to help acquire it. And they're only taxed on the piece that they're borrowing, which is the debt leverage piece. But I would say, and I don't know if you've run into this, but I run into it quite often, is I would say a lot of clients who invest in some multifamily deals and some, other types of investments, apartment buildings where they're not as active, but they're passive, they still might get hit with this UDFI, but the syndicators and stuff don't like to talk about it because I guess it's too complicated for them to talk about it. So that's why we got to get Adam Barr on here more often so he can dumb it down for us. So is that something that you see with the people that you deal with? Are you dealing with a lot of clients that are coming to you after the fact that they found out about it, or how's that working?
Yeah, absolutely. And by the way, your example of the multifamily syndicated deal there with an apartment building, that's the most common one. It's probably more than half of everybody I know that needs help with their IRA filing for UBTI. It's that. And you're right that the syndicators don't really feel comfortable talking about it because it's not, if you're not an accounting person and you're not in this world, I can imagine it's probably a little bit intimidating to try to explain that to investors. Yeah. So if you guys know any syndicators,
CPA, they don't want to give them tax advice, and then they send them our way, and we can't give them tax advice. So, but we try to at least give them enough information to be dangerous with, but we always have to defer to, you got to find a CPA.
And to that point, if you guys know any syndicators who would like me to talk to them about that, I love talking to syndicators because that's the work that we love doing as apartment building. So I'd be happy to help them with those questions and that sort of thing. But yeah, to your point, the UDFI is really only going to be on the portion that's debt leveraged. So in these apartment building acquisitions, you'll often have 70 or maybe 75% debt leverage on that acquisition. And so that's really the only percentage of the income that's going to be taxable. Basically, you look at when I bought this is an oversimplification, but when I bought the property, what was my purchase price on the property compared to the amount of debt that I took out as a mortgage? And whatever that percentage of that mortgage is of the total property price is roughly going to be the percentage of the income that you're going to pay tax on. And so it's really generally most cases going to be partial.
So in an example, if I was to break it down, let's just say I'm buying a 3-bedroom, 2-bath house. We won't go multifamily yet, and it's $100,000. My IRA borrows $30,000 from a bank. If I'm oversimplifying it, I'm 30% debt leveraged, right? So roughly 30% of my profits could be subject to this unrelated debt finance income tax. Not that all of it's taxed, but the piece that I borrow is going to be taxed. And it just makes sense because you're getting an advantage by using non-IRA funds to buy an asset in your IRA. Again, I would say that's just the leveling of the playing field. But when I've seen it, and tell me from your side of it, I'm interested to hear, it oftentimes seems like when the clients actually go and find a CPA to calculate it, after you guys work your magic and you could tell them how it works, but I've heard that you can, once the IRA becomes a taxpayer, it can use depreciation. It can use some things to kind of whittle down some of that tax. And oftentimes I see when the tax comes back, it's not as bad as they thought it was going to be.
Yeah. So I think there's several reasons for that. I know exactly what you're talking about there. Normally on a rental property, it's kind of relatively uncommon for there to be income tax due over the life of that rental property, at least for the first several years, because we have depreciation that can help offset that income. And a side note there, that depreciation is computed differently than it would be as a regular investor, because you don't get bonus depreciation, it's all straight line. So you don't get the super charged bonus depreciation that everybody's really excited about right now. But you still get enough depreciation that, generally speaking, the operating income for tax purposes will be zero or negative, and you generally don't owe tax until you sell the property. That's probably true at least 90% of the time. There are some cases where you might have to pay some tax as you go, but generally speaking, the tax we see due most of the time is when a property is sold. And just like an individual, an IRA gets to take advantage of what we call the capital gains tax rates with respect to its unrelated debt financed income. So if I sell, let's just pretend your rental property example there. Let's say we bought a rental property for $100,000, and let's say it's $50,000 mortgage on it when you buy it, 50% debt leverage, just for simplicity. You rent it for a while, and then 2 years later, you sell that property for, let's call it $150,000. So you've had a gain on the sale of roughly $50,000. Since that property was only 50% debt leverage when you bought it, really you're only going to pay tax on half of your gain, so $25,000. And then that's going to be taxed at the capital gains tax rates, which really, there'll be some portion at 25% for depreciation recapture, but generally speaking, your tax rate will be around 20%. And so your tax on that gain is really 20% of 25,000, which is like $1,200 or something. So it's not really that. Maybe I didn't do that math right. Anyway, you get the idea. It's not as much as you think it is. It's embarrassing. CPA can't do math.
Well, it's kind of funny sometimes, because oftentimes you'll get investors that freak out on this tax. And, the thing I'm thinking is, well, you have to have income in order to have tax. So you must be doing pretty well if there's something to tax there. But it also, goes, there's a lot of people that say, I've heard this misconception: I would never buy real estate in an IRA because you don't get depreciation. Well, in most cases, if you're not using debt, you don't get depreciation because there's no tax to depreciate against. So it's kind of a moot point. But once your IRA gets into a position where it does owe some tax, well, then you can use depreciation. And can you touch on something that I think the audience would like to hear? Why is it important for the IRA to look to that, the capital gains tax treatment? Because it's not taxed like a person. If it's taxed to the IRA, it's taxed like a trust and estate.
Like a trust, yeah, that's very true. So, by the way, I see a lot of great questions that I want to get to. So maybe we can do that after this. That would be nice, because a lot of these are like 10-second answers. But no, you're good.
Yeah,
you're good. But yeah, so UBTI is generally taxed at income tax rates that apply to trusts. Those brackets are very compressed. So you get to the top tax rate of 37% after like $13,000 of taxable income or something. And so in our scenario where we have an ordinary operating business like your pizza shop that you mentioned, the tax, it can be pretty significant because it's 37% of your income. The reason the capital gains tax rates are so important is because the maximum capital gains tax rate is 20%. And so on these things where we have a gain from a sale of a rental property, we're paying tax at a much lower rate. And also we get it discounted by the debt leverage ratio, right? So it helps a lot with minimizing that tax liability. Do you mind if I handle some of these questions real quick?
Yeah, it's your show, man. I'm just here.
Yep. Raj asks, invested into multifamily with self-directed IRA. If you're a passive investor, will UBTI be applicable? The answer is pretty much definitely yes, if they use debt leverage to buy that. As to what amount, it depends on, like we just were discussing, probably during the life of that investment, you're going to have very little operating income to pay tax on, but probably when you have a gain on the sale of that property, you'll pay the tax. But what amount obviously depends on how much money you make. We kind of just talked about that, so I'll leave it there.
Can I ask a question
What?
along with that?
Yeah, absolutely.
I'm
Sure.
curious, correct me if I'm wrong, but when it comes to the capital gain that you're trying to figure out how much of this is going to be taxed, do they look at the life of the investment, or do they just look at the most recent 12 months prior to sale?
Yeah,
How is
great.
that worked out?
I love that question because I know that you already know the answer because you asked the question.
Try to pretend.
So I think that there are probably 2 points to elucidate with respect to that. First is in the definition of what qualifies for capital gains tax rates in the first place. In order to take advantage of that more beneficial tax rate, you need to have held that property for more than a year, so at least 1 year and 1 day, so that it is a long-term capital gain. So that's important. The other thing that you're mentioning there is with respect to the taxability of the gain on the sale of the property. You're correct that I was oversimplifying before just to kind of keep it simple, but it is actually when you sell the property, what percentage of that gain is taxable based on your debt leverage is actually just based on the debt leverage over the preceding 12 months prior to the sale. And so a lot of times if you're paying down the balance of that mortgage over the term that you're holding the property, you're going to have a lower mortgage balance when you sell the property. And so your taxable portion of the gain would be less. And you have a real opportunity if you can find a way to pay off that mortgage balance completely more than a year before you sell the property. Well, then when you look back upon selling the property, you have no debt in the past 12 months, and therefore you don't have to pay any tax at all. In fact, you don't even report that gain as UBTI.
That's awesome. So that's where strategy comes into play. I'm talking to the audience now, is you could still, if you play your cards right, use debt to help you acquire property, but still get rid of the capital gains tax completely if you hold it long enough and have the note paid off. So if you imagine, if you were going 10 years in time and you bought this property with 50% debt on it, if you flipped it the next day, well, then you're going to have a lot of tax that you might have to share, or have a lot of tax you might have to pay to Uncle Sam based on the fact that you're 50% debt leverage. But if you hold the property long and you're paying the note down, which is reducing the amount of debt, and you're getting some appreciation. And I know for a lot of apartment investors, their whole strategy is to improve the value of the property through their strategies of increasing value. And then they refinance and the property is, worth $1 million more than it was. Well, again, when you're actually selling the property and you have that capital gain, they're not going to go back to when you bought it. They're just going to look back, what was the average indebtedness for the past 12 months? And if you paid the debt off in a perfect world and there was no debt in the last 12 months, well, then your tax is zero. So I think the way that strategy works out, again, if you play your cards right, it works great in IRA.
Yeah, and the counterpoint there, if you're in one of these syndicated multifamily deals and they do a cash out refi and you get those refi proceeds, and then they sell the property soon after, it's entirely possible that you'd be 100% debt leverage when you sold the property.
Right.
So I don't even know why I'm here, Nate. You're doing such a great job of explaining this.
No, but yeah, but you're the guy that you're the guy that's going to help them and do all this stuff. And, in helping them, let's talk a little bit about the process. And again, you feel free to take questions if you want, but person finds out that they have tax in their IRA, they have an investment that's taxable. What's the process? The forms can't be the same as people forms. So we're talking about an IRA. What's the process? What are the forms? What are the deadlines?
You got it. First thing I'm going to do is draw a sharp delineation here. I want everybody who's on this webinar to never again think of their IRA as being the same as them. Your IRA is a different taxpayer from you. In the eyes of the IRS, that is totally separate from you. It's a different entity. It is its own taxpayer. So we're going to talk about some filing requirements here. These are with respect to the IRA, and they have nothing to do with your personal tax filings or you paying your personal tax. So we'll always remember that. But if an IRA has, like you said, income from a source that is UBTI, and it has that gross income is more than $1,000 in any year, that IRA then has to file a Form 990T, which is a tax return for the IRA, to report its UBTI and pay any tax due. So that form is due April 15th, like your personal return is, and it can be extended until October 15th. But if you choose to extend it, you have to pay any tax that you think will be due with your extension. And generally speaking, it's going to be a bit tough to do that form on your own because it is a little complicated and it involves debt basis calculations like we've been talking about. And starting last year, the IRS actually requires that form to be e-filed. And so individual IRA owners, I think it's really outside of the scope of, I don't think they're really going to be able to do that. So you probably need a tax advisor to help you with that. I do those. I don't know a lot of other folks or really anybody else who does them, which sounds like I have a monopoly on it, but I don't. Anybody can learn.
Well,
but
I'll tell you this,
people don't want to touch it.
I get the question all the time. Do I know a CPA? And I go, there's not that many of them out there. So that's why we got you on.
Yep. So, but basically the point is you have to file 990T, which is a tax return, and you have to pay that tax. And that tax has to be paid from the IRA. So it's important that if you have a realization event where you're selling a property or recognizing some kind of income or gain, you have to hold some of that back within the IRA so that you have money to pay the tax and don't just immediately reinvest it all into something else, because then you end up in a little bit of a pickle.
And just to clarify too, it's very important what Adam said. This is not your personal. This does not affect you personally. So when you're talking about the 990T, that's going to identify the IRA as a taxpayer. One quick note, I will tell you guys for IRA clients, when your IRA files the 990T, it's very important you get your own EIN number that associates with directly to the IRA. Some people make the misconception that they use NuView's EIN number. You have to correct it every year and go back to them and say, no, we're not the taxpayer, it's your IRA that's the taxpayer. So you do have to get its own unique EIN number, but the IRA pays the tax, not you personally. We pay the tax out of the IRA. That is part of the service in NuView. We do it every year. We're doing them right now. People are giving us their 990Ts prepared by their CPAs, and we're sending that tax payment from their IRA to the IRS. So again, all of this is in and out of your IRA. I'll take a question real quick, and if you want to take a question too, feel free, Adam. But
yeah, sure.
Jennifer at the bottom, I just noticed you said once you get to 59.5, and if you sell your IRA real estate property, there are no taxes, correct? Again, in most cases, you're not paying taxes, but we're talking about, if you're talking about your IRA owning that property cash, you don't have to worry about the IRA paying any taxes when you sell the property. Depending on the IRA, you may pay taxes as you take distribution, and that's dependent on the type of IRA you have. What we're talking about here is if you have an IRA investment, real estate per se, that has debt on it, that's unrelated to the IRA. It wasn't used as IRA funds. You have to pay a special tax on that debt leverage piece. And that's what we're talking about here. So, but if you don't have, again, just to clear the air, if you don't have debt on the property, you don't have to worry about paying taxes when you sell property in your IRA.
Yeah, but you still might have taxes when you withdraw the money from the IRA, as you just mentioned, if it's a traditional IRA. John asked, does this apply to Roth IRAs? I get that question a lot. The rules are exactly the same for a traditional IRA and a Roth IRA. So don't conflate the fact that a Roth IRA gives you tax-free withdrawals with it being tax-free for UBTI purposes, because that is not true. Roth IRAs have to pay UBTI, pay income tax on UBTI, just like traditional IRAs do.
And I'll add to that, because that's a good point that you made. John, if you're thinking about it this way, again, this UBTI or UDFI tax that we're talking about is not something to be scared of. But if you are going to incur it, some people would make the argument that it's better suited in an account that you're not going to get taxed on distributions, because therefore you might make the argument that you're getting taxed twice. So if you do this strategy, it oftentimes makes sense to use a Roth IRA, use an HSA. We'll talk about the Roth 401k here in a minute, because you're not going to get taxed on the distributions, but you might get taxed on the sale of the property if you have debt on it. So just a strategy play there.
I agree.
Yep. Let's see. We've got another, take another question. Would I be able to invest IRA capital to fund personal ownership of a multifamily property? Is that allowed or not allowed? What is the UBTI implications in that scenario? I'll take the piece of this if you want to add anything onto it. But if you want to take your IRA capital to fund personal ownership, that's a different conversation. This is something that we talk about. There are investments that could be considered prohibited. if you're using your IRA to invest in something personally. Remember, your relationship to your IRA is to help it grow, and your benefit from the IRA is from the distributions you take. So there are some rules that prevent people from self-dealing. If you have a property, you can't sell it to your IRA because you're doubling up on your advantages. You can't self-deal your IRA to your own property or get any personal benefit from the investment. Your benefit has to remain in the distributions you take from the IRA. And we've got some education on that as well. I don't want to get too deep on that.
Well, I agree completely. You just want to make sure that you're never self-dealing between yourself as an individual and your IRA, or members of your immediate family who would be disqualified persons. And that would be spouses, ancestors, spouses of ancestors, descendants, and spouses of descendants. You never want to be dealing with any of those people between your IRA and those people, because it would be a prohibited transaction, which is bad. Because a prohibited transaction, basically, if the IRS finds out that you did one, your IRA ceases to exist as of the first day of that tax year, and the entire balance would be taxable and subject to penalties, and that's no good.
So you don't want to do that.
Don't do it.
If you play by the rules, again, you play by the rules and this is why they're strict with IRA rules, and that they don't just slap you on the wrist like you misfiled your taxes. If you do something prohibiting your IRA, they basically look at that as the worst thing in the world, because your IRA's got great tax advantages. And if you use it right, you can get off the grid. So they're going to be stricter with people misusing their IRA for the wrong purpose. And again, when you have this great tax advantage vehicle, and you can use these strategies that we're kind of hinting on, which is using the acquisition of debt to help you either buy more property or buy bigger property, you just got to look at your returns. You got to deal with a competent CPA that can help you run the numbers. But if you're looking at it from the perspective of cash on cash return, look at that, not the tax. The tax to me is a cost of doing business. It's does my cash on cash return increase? And I'll just give a quick example. If I have $100,000 in my IRA and I'm looking at one property and I can do all cash on that property, will that make me more money than buying 3 properties with down payments and financing from a bank? I know I'm going to have to pay tax in that scenario, but is my profit going to be larger because I'm acquiring more property with the acquisition of debt, which is unrelated to the IRA? It's a simple numbers game when you look at it that way.
I agree. It's all about the after-tax return.
Yeah. Yep. So let's get into a couple things, and this is stuff that I'm really curious on because you follow this a lot, and I really want to know about this because I nerd out on stuff like this. But there's been some recent changes in the past couple of years, and I didn't even know about all this stuff. So can we talk about the new silo rules that have kind of come down through the Tax Cuts and the Jobs Act? I know just happened in the last couple of years, and there's a lot of things going on. But a lot of this stuff relates to IRAs and things. So maybe you could talk to us about that.
I'll try to keep it brief because this could be a long and technical, boring explanation, and I'm going to not do that. But the gist of it is we kind of dodged a bullet on this one, and we're very happy about that. But when the Tax Cuts and Jobs Act passed in late 2017, they basically said, hey, if you're an IRA and you have UBTI, every single trade or business you have is treated separately. It's siloed. And so the losses from one activity can't offset the income from the other. So you might have to pay tax even though you have a loss overall among your various activities in your IRA. Well, that was terrible. And there was a lot of backlash. The public accounting industry wrote letters to the IRS and blah, blah, blah. So eventually they softened that approach. And what they landed on was, okay, if you have several different business activities and they're all in the same type of business, then we'll treat that as one silo. And so you can offset your income from one activity and your losses from another activity. And so you can pay less tax basically until you recognize income overall. And that was actually ended up being defined pretty broadly to where real estate is really all considered to be the same business activity. So even if you have an apartment building rental and you have a commercial property rental and you have a single family home and those are all in your IRA, the IRS would basically treat that as one business activity for this purpose because they're all real estate activities. And so we kind of came out with a good result out of what could have been a really unfortunate situation. So we were very happy on our side about that.
Well, that's good. Yeah. I mean, And we were also writing letters on the other things that they're passing too. So I'm glad that you guys kind of jumped on that, because that helps the investor. And again, guys, this is helpful to have a CPA that's not only investor friendly, but understands these self-directed IRAs. And we've got the guy on with us.
Yes, sir.
What are some of the other things that they had? I see the IRS notice 2018 and the proposed reg. Is this all the same?
Oh we went through all that. I gave you the super short version, but yeah.
Okay, that was awesome. Yeah, you broke it down real simply. I got that. So we have a couple of good questions on here. I'm going back and forth from the chat to the other thing. So I want to kind of address some of these because you guys are having some good questions here. This is the most questions we've ever had, by the way. So this is good. Let's see. Suzanne, hey Suzanne, she says, it sounds like we're taxed twice on this income. And again, yeah, I think I mentioned that if you're investing in a traditional type account, you could view it as being taxed twice, but again, doesn't make it bad. It just makes you want to have that as your analysis though. If I'm going to get taxed with some UDFI tax, maybe I do this in my Roth instead of my traditional. I want to bring something up. You can chime in as well, Adam. There's some strategies now if you are, and this is just for debt leverage property, by the way, this is for UDFI only. If you're self-employed, we've got a vehicle that has a special exemption to this UDFI tax. So again, I kind of hinted that if you're going to pay the UDFI tax in an IRA, maybe it's better to do it in a Roth or an HSA where you're not taxed on distributions. But if you're self-employed and you have this thing called a solo 401k, I believe there's a built-in exemption to the UDFI tax altogether that you don't even have to pay it. Is that right?
Yep, I'm glad we got here. So if you have a solo 401k, and I'm sure that you guys do self-directed solo 401ks at your company there, solo 401ks, because of the way the tax code is drafted and they're defined under a different section of the tax law, they're actually not subject to the unrelated debt financed income rules. And so if you have a debt financed asset such as a rental property in a solo 401k, the income from that property, including any gain on selling the property, is not going to be subject to tax at all. 401ks still do have to pay tax on UBTI if it's from an operating business. So if you have a 401k that owns a laundromat or a pizza joint, then that income still will be subject to tax under the UBTI rules. It's only the UDFI that we escape, but we do indeed escape it. And so there's a big incentive to try to get your funds from an IRA into a solo 401k if you qualify, which we can talk about, to help you avoid recognizing any or paying any tax at all on these debt finance investments in real estate and other things.
So see, this is where it gets fun to me, because you can look at your accounts, and this is a great topic, and it's going to give you guys some things to think about, audience, as to what investments do you have in your IRAs currently and what investments do you want to look at. If you're buying debt leverage property and you have the ability to have a solo 401k, well, just make sure that you're buying your debt leverage property in your solo 401k and you don't have to worry about the UDFI. Maybe save your IRAs for some other investments that don't trigger UDFI. I kind of mentioned this as well. This goes a little bit off topic, but look at your other accounts too, clients. Do you have HSAs that are invested in long-term investments? Maybe those should be invested in shorter-term investments because the profit can be distributed immediately tax-free for today's benefits. Things like that. Thinking, when can I use my IRA or HSA for the tax privileges? Maybe I have these HSAs and ESAs invested shorter term and I invest in longer term things in my Roth. And when we're talking about debt leveraged investments, use the 401k so that you don't have to pay the tax. There's all these little creative strategies that you can apply to yourself here. And that's where it gets kind of fun. I do want to make sure we hammer home that, because there is a lot of misconceptions. I get people coming up to me all the time thinking that the exemption applies to UBTI and it's just UDFI, not the business tax.
Yeah.
I want to ask you this, and I won't put you on the spot here, but there's, and again, we're not attorneys, guys. We're not giving legal advice here. We're just kind of analyzing things. When they're talking about the exemption that 401ks give you, I believe the term is it's to real property and real property in comparison to dealer property. Dealer property is operating a business, but dealer property in the eyes of a real estate investor could be flips. This often gets a little bit confusing as to how many flips would you have to do in a 401k to be classified as dealer property versus real property. I don't know that it's clear. I do know that there's some attorneys that one says this thing and one says the other thing, but do you have anything that you would say to people that are flipping property in a 401k that are trying to get out of the UDFI?
Yeah, basically you're not going to get out of it.
No.
But as in all tax questions, the answer is it depends. They all have the same answer. But what really matters is not the number of properties, because as you mentioned, there is no number of properties in the tax code or the authoritative literature saying if you do 3, you're a dealer and you have dealer status and everything is ordinary income. It's not in there. What really matters is your intention at the time you purchase the property.
Yeah.
And so if you purchase a property, even one property, if your solo 401k buys a house and at the time that you purchase that property, your intention is to renovate and resell it immediately for a profit, then that's a flip activity. That's an ordinary trader business, and all of that income would be UBTI regardless of if you had that leverage or not. Because it's, I mean, 401k notwithstanding, it's ordinary income. It's not income from a debt leveraged investment.
And I don't think most clients are doing that, but it's a good thing to look at. Most of, I understand most clients are long term and they have, but you kind of mentioned something there, and I want to, I don't want to put you on too much on the spot. Your intention when you buy the property. If my intention is to hold it, and let's say it's not looked at as a flip, I don't do a major rehab on it, I buy it, and some life event happens that I just decide it's the best decision for my IRA to sell it. Could that be viewed at differently? And that all comes to that word you used, depends?
Yeah, no, again, it depends on the facts and circumstances. But in that case, in this example, your intention is to hold the property for investment. So if when I purchase a property, my intention is to renovate it and rent it out and hold it as an investment, and then 18 months later, somebody gives me an offer I can't refuse, and I sell the property, then I think it's very clear at the time you bought it, your intention was to buy and hold it. And so it wouldn't be considered, you wouldn't be considered a dealer, and that wouldn't be considered ordinary income. It would be capital gain on the sale of the rental property. So it really matters. And, you can, obviously your intention on something is up to you, but you have to be aware of what the facts and circumstances and your actions say about your intention.
Right.
I mean, it's not going to be enough to just stand up there and say, Judge, my intention was to hold this as a rental, if all of your actions say the opposite.
Yeah,
right?
if you've already flipped 30 properties and you're trying to make the argument that you weren't going to flip this one, or you did a heavy rehab, never rented it and then sold it, it'd be hard to make the argument that your intention was to hold it. But and I know that this happens. It happens in real estate. You think that you're going to do this, and especially with the crazy market we are today. I know a lot of investors that are real estate investors that normally hold and prefer to hold have been selling just because of the prices that are being offered right now.
Oh yeah,
we're overbidding for properties. So the governing bodies that realize that there are life events that happen. But I think Adam put it the great way is if your intention was clear that you were going to flip it, you're not going to get away with that being a real estate investment. It's going to be probably considered dealer property. A lot of good questions, Adam. If you want to take some of these, I'm trying to catch up on this. So
yeah, let me. We've got more than one person asking about how to qualify to have a solo 401k, so I think we should address that.
Great.
So the question, how do you qualify for a solo 401k? Somebody else said, how does one qualify converting an IRA to a 401k? Just to clarify there, the qualification isn't on rolling over an IRA to a 401k. You can always do that. The whether or not you qualify question is really based on setting up the 401k in the first place. So if you want to have a solo 401k, then really a prerequisite of that is you must have a profitable business activity. And that can be, I'm self-employed as a consultant. That can be, I'm a real estate, self-employed as a realtor, real estate agent. That can be, I weave baskets. I don't care, but it has to be some sort of business activity. What won't get you there is owning rental properties will not get you there because that's rental income. It's not self-employment income. I had a guy ask me this yesterday. I couldn't even believe he asked me. He said, hey, I work for a company as a W-2 employee. If I have my company pay me $1,000 and pretend it's a consulting fee, can I treat that as self-employment income and set up a solo 401k? And I said, absolutely not. That's insane. Don't do it. But you have to be able to show that you have a profitable business activity that the solo 401k is attached to, and you have to make contributions to it and sort of make it like, hey, this is a real thing. You can't just set one up because you want to, if that makes sense.
Good, you brought that up, and I don't want to get too off topic, but this is something that I've always been interested in. Is there any rules with people setting up a solo 401k? Because we're actually having, right now, we're having a flood of people setting these up for the first time, and it's a much longer consultation with the solo 401k client, because we have to make sure they qualify for it and they understand what they need to be doing with it. I've heard some people say that you need to legitimize it. Is that something that you have to do, or is it just a mere fact that you have to have the intention that this is going to be a profitable business going forward?
You're not going to find that in the tax code, but again, that's an example of we want our facts and circumstances to support our position. And when you say legitimize it, I believe what you're referring to there is making contributions to it based on self-employment income on a yearly basis, and you know, treating it like a real 401k. You would want to do that. Can I point you to a section of the tax code where it says you have to? No. But do you want to, I don't want you to be in the position where you're trying to defend this as a real 401k if you've never made any contributions to it. You just had $1,000 of self-employment income and you rolled over a $500,000 IRA balance into it and used it to invest in debt leveraged assets. I mean, it doesn't look right. So you got to have your facts and circumstances supporting your position.
Right. So the 401k, the intention is that if you're a small business owner or you're self-employed, that you're going to use that as your retirement vehicle. And most people that have those types of vehicles make contributions. So some people, you know, they think, oh, I'll just roll over my IRA. It's got 500,000. That's enough of a contribution, but that's not the contribution we're talking about. That's not even viewed as a contribution. That's viewed as a rollover. With the 401k, there's some arguments that you should at least be funding it with annual contributions. Again, there's no definition of how much that needs to be. What I usually tell clients is, talk to a CPA, call Adam, or it has to pass the smell test, right? If you're showing that you make $100,000 a year self-employment income and you make a $10 contribution, I would say that doesn't pass the smell test.
Well, you can't anyway, because your contribution is limited to a percentage of your self-employment income. But yeah, point is well taken.
Yeah, so again, use it for the right purposes. And again, we're not trying to overcomplicate it, but these are, again, I would say we're not overcomplicating it, but I run into clients all the time that don't get this information from the people that they set their 401ks up with. And it's, again, it's kind of heartbreaking because they should explain all this stuff and the UDFI stuff, and at least give the clients the opportunity to look at it prior to and not get, you know, blindsided by it down the road. So this is great that we have you on and we're talking about this. So are there any other questions that you want to take? I know we're getting flooded with a bunch of them.
Yeah, I'm looking through the list here. Somebody asked, with respect to the solo 401k, can it be an LLC that flows through your Schedule C? Yeah, absolutely. That LLC is a disregarded entity, so it gets reported on your Schedule C on your personal return. You can definitely have a solo 401k associated with that activity. That's all good. I'm trying to see if there's any other quick questions because I know we're probably short on time here.
I've had a couple clients, again, I want your take on it. They were asking me just the other week, do they have to have an entity? Do you have to have an LLC, or can you just be a sole proprietor?
You can be a sole proprietor.
Yeah.
It's not that common to see people who have a sole proprietorship without an entity anymore, just for liability reasons. But if you're in that position, then yeah, you can have a solo 401k, but you're going to have to apply for an EIN for yourself as an employer, and then use that as the EIN associated with that 401k. But you could do that. I don't know how much more complicated that is on your side from an administrative perspective, but it's possible.
It's not really. It's actually less complicated because they're doing the tax reporting at that point. That's one of the. I think 401k is a great product, but once it's in the client's hands, it's really them doing the tax reporting. So again, this is all good stuff that they should understand.
Yep. Okay, so Stephanie asked, what about one's S Corp business that would pay full market rate? I assume that the question is, if I have ordinary income from an S corporation going into an IRA, is it taxed at the full ordinary income rates as UBTI? The answer is actually that an IRA is not an eligible shareholder for an S corporation, so that situation is not possible. But if you did have some sort of ordinary business activity going into an IRA from a pass-through entity like a partnership, then yes, If it's ordinary activity from carrying on a trade or business, then that would be subject to the full ordinary income tax rates under the UBTI rules.
Awesome. There's a great question. I was waiting for somebody to ask this question. I'm glad they asked it, but they said, I'll paraphrase, if my IRA owns debt leverage property and there's some capital gains tax, can I use a 1031 to defer that tax to my next investment?
So I'm assuming that this would have to be a rental property owned by the IRA itself.
That's how I would take it, but
yeah, I'll admit to you that I'm not 100% sure on that, but I'm 97% sure that you can do that.
Yeah, I was going to say 97.5% sure. I've asked a lot of people. They say that there's nothing saying you can't. I haven't seen a client do it though.
Right.
But there's nothing in the rules that says an IRA can't use 1031 opportunity on the taxable portion.
Yeah, I think it would work, but if you were my client, I would want to research that before I sign that return for you. I'll put it that way.
But that's good. I like how you're thinking out there. That's what I was thinking the first time I heard it is, can I use that to defer the tax, at least on that piece of it? So great question. Let's see, are there any other ones? 1031, S Corp, a lot of good questions, guys. Adam, do you have some contact information that you want to give out, or do you have any resources that people can check out if they want to learn more about you, or maybe for some services?
Yeah, should I just type it in the chat here? I can do that.
Sure, yeah. And for the people that aren't in the chat, because this gets recorded, just spell
I'll say it out loud too. Yeah, sure. So our website, which is the best first resource for you to look at because it has lots of information about who we are and what we do. That is mgallp.com. And there's actually a contact us link in there that you can use to contact me. I would probably prefer that that's how you guys go through it so that I don't just get flooded with a bunch of emails right away. So you can go to the website. It'll show you all sorts of things about what we do, and you can contact me through there, and that's mgallp.com.
And I'll just preface this because he's being nice. I know what these CPAs are going through, and guys, just be conscious of his time. You know, he's one of the rare circumstances of a CPA that understands real estate, self-directed IRAs, UDFI. So try not to bombard him with, just your average questions. Try to get, if you've got some real substance there, or even if you're a small to medium business owner, I know they specialize with working with those types of clients. So, and I know we have a lot of those clients that fit that box at NuView, people that run their own businesses. They self-direct their retirement accounts. They might have a solo 401k. They buy debt leverage property. Some of you guys are on here with us today. So those are the clients that Adam really likes to work with because they can help them in many different facets. And if you have IRA questions, just contact us. Just reach out to us. I think we've got our email here. It's IRA specialist at NuViewTrust.com. If you have any IRA specific questions, send that our way. And if you are looking up to set up more accounts too, now's the time to do it. Shameless plug here, but we are heading into tax filing season. There is still time to make contributions, not only to your personal plans like your traditionals and your Roths, but also to your HSAs. As long as you have the insurance already set up last year, you can make contributions to your ESAs, and you can even make contributions for 2022. And I know a lot of clients are putting more money in their retirement accounts because, again, there's more investment opportunities. Without getting into all the crazy stuff that's happening now, a lot of people are looking at what are the opportunities for me to invest in as the market goes sideways, or whatever you're investing in. Now's the perfect time to start funding your retirement vehicles because you can double up on the contributions, make contributions for last year and make contributions for this year. And again, that might help you with your buying power if you're going to start using strategies like using debt to help you buy more property, or even buying into businesses. So Adam, I want to thank you. I don't want to cut it short. Is there anything else that you want to go over? I know we had a great conversation, went a little over. I know our audience will stay on for hours if we let them, but I know you've probably got some stuff to do.
I'm pretty much good. Will McNeil in the chat made a great point a few minutes ago. Capital gains tax rates are pretty low right now, or relatively speaking, compared to what was proposed recently. It didn't pass, but capital gains tax rates could be higher in the future. And so, you might want to pay the tax now rather than doing a 1031. So just something to think about. And he made me smile by saying that.
Well,
So
our clients think the same. They're like us. They see opportunity, and a lot of them have been around a while. I don't want to point out anybody, but a lot of our clients have seen the cycles, and they know that we're in a pretty good time, at least when you're looking at tax rates. And again, using these strategies, you can use them to your benefit. And I would say one of the things that an IRA or even a 401k gives you that the 1031 doesn't give you is just the ease of just investing when you want to invest. Nothing against the 1031, but again, it's hard to use the 1031 with the time restraints and the type of property that you have to reinvest in. Again, do that personally, but make sure that you're using that tax advantage ability that inherently comes with the IRA. So again, if you haven't set up accounts with us at NuView, get those done. Contact us, IRA specialist at NuViewTrust.com. We do got a little special for the month. I will throw that out to you guys. If you open your account between now and the end of the month, we're not only waiving the account opening fee, and that's for all accounts, but we're also giving you a $50 fee credit, and that just goes toward your future transaction fees. Again, we don't make commissions at NuView. We just charge a small transaction fee or small administration fee and an asset fee for holding your assets. And we'll even give you a little bit of a credit towards your next investment. So now's the time to get it. Contact us, IRA specialist at NuViewTrust.com. If you have specialized tax services that you need, reach out to Adam Barr. He's one of the great ones. I'm sure we're going to see him around. Maybe we'll try to get him out to our next investor retreat. Wink, wink. We'll see if he'll come out. I know a lot of you clients were at our investor retreat. We are in the works of planning ours. We know when it's going to be. We don't know a specific date, but we know it's going to be this summer. So stay tuned for that, because we have a lot of people asking when's our next one after they came to the first one, right, Grace?
That's right.
Yeah. So keep it. So we'll make that notice, and maybe we'll see Adam either there or at another one. I guess we meet Adam face to face. So again, thank you so much, Adam. I appreciate your time. Great webinar. I think we broke the record for most questions on one of our webinars by tenfold. So.
sure. Sorry we didn't get to everybody, but that's what you guys are a resource for. So hopefully they'll reach out to you on those, and I'm happy to help too. So.
Yep. So again, yeah, if we didn't get to your question, guys, email us there. If it's specific to Adam, he gave you guys the resource to use there. So thanks everybody for joining us. Thank you, Adam, and we'll see you guys next Wednesday for another NuView workshop.
Bye, guys.